Well, thank you very much indeed for joining us today. Insofar as we can see where everyone is from, which isn't easy in many cases, I'm pleased to see that we have people joining us from an awful lot of different countries today, from many different countries across Europe and the US and Canada too. So welcome to you all. This discussion today is timed to coincide with the launch of a white paper we have published with Fathom on risk in climate change investing, and we will be delighted to send that to you once this online event is over today. And what I'm going to do in a minute is sum up just a few of the main findings in that particular white paper. First, before doing that, for those of you who don't know us, and I think there's probably today, particularly quite a lot of people in that category, I should tell you that IFI Global is a research and media house based in the city of London. We have, as well as our research side, we have 4 publications, 3 monthly and 1 weekly. And one of those is SII, which stands for Sustainable Investment Intelligence. And that has just been renamed. It used to be known for the last few years as the ESG report. It got renamed in September, and we decided to rename it because we really do want to focus exclusively upon and specialize on the main sustainable and environmental sectors that investors are interested in. And we wanted to lose all the ESG baggage, and increasingly we're coming around to the view that a lot of the ESG baggage is irrelevant to what really matters in sustainability and environmental investing. SII, for example, has been and will very much continue to collect a lot of data on allocations from pension funds, sovereign wealth funds, family offices, to the different sustainable sectors. And we are charting how that's changing. And as you can doubtless imagine, it's changing, particularly in some of the sectors, very quickly indeed. Finally, before starting, I wanted to thank Fathom very much for their sponsorship and support, both of the white paper I've referred to and of this particular event today. So before getting into the panel, as I just said, what I'm going to do is quickly sum up a sort of an 18-page white paper, which we will be delighted to send on to you after this particular event today. So I guess one of the big themes, if not the biggest theme of the white paper, is that climate risk will become, if it isn't already, one of the most dominant areas of fund management for years and probably for decades to come. And part of the reason for that is that the problem of climate change looks to be graver than even the pessimists feared until recently. The WMO, the World Meteorological Organization, publishes figures every month of the global climate, and the figures they published for this last month of September were called by one leading climate scientist, quote, gobsmackingly bananas, unquote. And September was a record for that particular month in the history of the world by some degree. And it was, for example, 1.75 degrees centigrade warmer than that same month in any of the pre-industrial periods up until the year 1900. But of course, it wasn't just September. Pretty much everywhere in the world, with the possible exception of the UK, where we in the UK had a pretty poor summer, but in the United States, where I was for a lot of the time, across Southern Europe, astonishingly very strange temperatures occurred. And the likelihood is these incidents, climate events that were supposed to take place only once every 100 years, are now taking place at an increasing frequency, as we all know. The Financial Reporting Council, which is a very august body here in the UK, the FRC, as it's referred to, has published its 2023 report recently. And one of the main findings is it says asset managers need to have a much better idea on how to price climate risk than they have been doing so to date. And there is an awful lot of evidence, and we'll get into this in the discussion very shortly, that the risk in climate investing, it has been underpriced, if not severely underpriced. And as DWS, the leading German fund managers, says, it calls this underpricing, quote, valuation mirages, unquote. I love that quote because it really does, it is a mirage, some of the valuation quotes that have been going on in climate investing. It's likely that the physical threat to assets from climate change and then mispricing will become, if it isn't already, the biggest single risk factor for fund managers outside market risk. For example, Ed Heck has, in a report they just published the other day, this is the French Business School, claims that infrastructure investors could lose up to 50% of the value of their portfolios by 2050 if nothing is done to mitigate climate change by then. But it's not just infrastructure investors. S&P state that almost 60% of the companies in the S&P 500 and 40% of the companies in the S&P Global 1,200 hold assets at high risk of physical climate change impact too. The real difficulty, and this is a point we're going to come back to probably again and again over the next hour, is in quantifying the risk, including the indirect risk. I mean, the direct risks are difficult enough. The indirect risks, including a risk from suppliers or lack of supply if something goes wrong in the climate, are well nigh impossible to calculate. And as I say, we will be getting into that in a few minutes. People are gravitating to this thing called climate VaR. VaR, of course, value at risk. Climate VaR is the climate equivalent. It is, I guess we would call it, and we've called it in the white paper, the least bad alternative for measuring climate risk. But it has many, many shortcomings, and we'll, as I say, we'll be touching upon that, and we touch upon that in the white paper. But as I say, it is almost certainly the least bad alternative given the situation we are in. The white paper also covers regulatory and litigation risk. Regulatory risk for asset managers is basically on two different levels. First of all, looking at the companies that they may want to invest in. What happens if one of or more than one of the companies they're investing in gets heavily fined for falling foul of the regulations in whichever countries they may be in? That's one risk. And then the other level of risk is, and this is coming along to a greater extent today for the first time, is their own risk of failing to comply properly with the regulations aimed at the fund management industry, like we have here in Europe with the SFDR. And of course, it's not necessarily a risk, but costs associated with implementing that particular directive. And then there's litigation risk. So far, from what we can see, we've done some investigating into this. There's been roughly 2,000 legal cases that have been linked to climate litigation to date. But this will, in our estimation, exponentially increase in the near future because, surprisingly, the US was very slow to get on the bandwagon in climate litigation, but it's catching up fast. And the US, as you doubtless pretty much all know, is a very, very litigious place. So we will almost certainly see a lot more climate litigation coming out of the US than we have done in the past. And it's much easier to do climate litigation than perhaps many of you would realize. There are funds being launched to help people with their litigation. And another alternative is crowdfunding. USS, one of the biggest pension funds in this country, was subject to a crowdfunding suit by a number of professors who took it to court over its environmental commitments. The white paper lists examples of where asset managers and pension funds have been caught up in this to date. And if I was betting, I would, and if we were to publish this white paper again in a year or two's time, I think it's quite likely that list will be a lot longer. So all of this means that fund managers will have to get their governance structures right for the climate. There's a lot of literature, we touched upon it again, the white paper to suggest they haven't done that to date, but it's something they're really going to have to do. Pension funds will be spending a lot of their time investigating their governance structures or the managers they're looking to invest with. And if the managers can't satisfy the investors on this matter, then those managers are really going to struggle to raise capital in future. So that's enough from me by way of introduction. I'm going to stop sharing screen and bring the panel up, I hope. Fantastic, there they are. That's my technology stress, hopefully over for the day. I'm going to ask them all to do a brief introduction of who they are. And I would say to you out there, please do, we want to encourage questions. Don't wait until the end. There may not be a period at the end when we'll have a dedicated period to questions. So if you have a question, fire them in as we go along. Just use the Q&A at the bottom of the screen. As I say, if you wouldn't mind, all of you, Karina, perhaps we could start with you. Just give a brief introduction of yourself and your role at Fathom.
Thank you, Simon. So good morning, good afternoon, everyone. I'm Karina Vaughan, and I lead on climate risk in global financial markets at Fathom. So we are specialists in high precision flood risk intelligence worldwide under any climate scenario. And we work with regulators, with central banks, asset managers, and large financial institutions to help them to integrate climate risk considerations into financial decision making. From a use case perspective, this includes due diligence, stress testing, climate scenario analysis, disclosure requirements, and the development of sustainable finance frameworks that account for climate-related risks, such as flood risk. Our data sits firmly under physical risk in the assessment of assets, infrastructure, and supply chains worldwide. And we also see increasing application in developing and emerging markets where data availability is poor, and there is a need to understand climate change at a local level to increase and facilitate the flow of capital into infrastructure and other projects.
Thank you. Paul, because you are not unmuted, sorry, you're not on mute, so come to you next.
Yeah, no problem. Paul Price, I'm CEO of Haven Green Investment Management, is a MiFID company fully regulated within the EU by the Central Bank of Ireland. As a company, we lead in sustainability and impact ethos. We're focused on helping growing the allocation to investment management firms that are in this space and dedicated to either already deeply involved in the sustainability and impact side or are very committed to the transitionary effect of improving their standards to get there. So yeah, we help managers from the EU underneath our regulated entity and beyond through partners throughout the globe.
Thank you. And I should say Dr. Peter Cripwell, if I'm right, with 2 PhDs, if my memory serves me correctly, unless you've added one since I last introduced you.
Definitely not. Hi, folks. Sorry, I'm Peter Cripwell. I'm the risk manager. I'm the chief executive officer of Risk System. We're a risk services company that provides risk, regulatory risk, and data management services to our clients. And with specific relevance to this panel, we also, over the last couple of years, has been developing an ES&G, notwithstanding Simon's view that the S and the G are baggage, functionality, so fully integrated with all of our other risk services to our clients to allow them to sort of fulfill obligations under the Article 6, 8, and 9 regulations, and also if they are so inclined to do some sort of risk management around the concept of climate risk as well.
Thank you very much. Well, let's get on with the questions. Karina, can I come to you first? What do you and what does Fathom consider to be the best way to calculate climate risk when, as I referred to in my introduction, the recent WMO data shows that temperatures are rising faster than forecast, even by the pessimists, and these catastrophic weather events are coming along at increasing frequency. So there's no historical data. This is the point that people, the number crunchers, the likes of the Peters and the Pauls, can rely upon to project out what's going to be happening in the future.
I mean, interesting question, Simon. And, I think if you look at what has happened across the last couple of years, the efforts that we've been making to reduce global warming have really been focused on the risks and the economic implications associated with decarbonisation. And as a result of that, physical risks have been unaccounted for, and climate risk data, climate risk information has had quite limited value for investors and asset managers. And really what we're seeing today is something quite different. We're seeing a really dramatic growth in what is a largely unregulated global climate risk data industry, where large advisory firms, banks, and some of the very well-established data providers are competing with nimble startup businesses. And we are seeing the development of new climate risk scores, climate risk ratings and indices, not just by those traditional data providers, but also by financial institutions, asset managers, and insurance companies, all of whom are developing proprietary climate risk data services. And we provide flood risk data to all of those. And so how do we see climate change risk being calculated? Well, first of all, flood risk is being prioritized. And of course, I would say that, wouldn't I? But, if you look at how the insurance industry has used flood risk for a very long time now to assess financial and environmental vulnerability and to set premiums. And certainly we see the investment industry starting to see the same value in flood risk data. And I mean, when you think about it, flooding is the most devastating form of natural disaster. But its intersection with credit risk in the context of investment and financial risk management means that the failure to adequately price and account for climate-related flood risk can lead to an increase in systemic financial risk through the interconnectedness of our financial institutions and markets. So second thing that we see is really robust climate scenario analysis, and not just using the moderate scenarios or the standard SSP and RCP scenario frameworks, but in the development of some quite extreme scenarios that reflect real world situations. And the University of Exeter has done some really excellent work here in developing a new range of scenarios from optimistic through to pessimistic, with a view of giving us richer, broader, and more realistic range of possible scenarios on which we can base investment decisions. And then I suppose the third thing that we see is really this focus on data. We're seeing a fundamental shift in how the investment industry buys data, with a real need to look under the hood of black box data providers and understand the methodology that sits behind the data. And for some time now, customers have been asking us about certainty scores. And so we offer metadata. And I think metadata in particular is set to play a bigger role across the climate risk industry in better assessment of risk to assets. And finally, then, the use of geospatial technologies, and maybe I'll talk a little bit more about those later on. But, if you think of satellite technology providing real-time access to to climate risk information at an asset level, and the ability to trace data back to source, which ultimately I think will increase the trustworthiness of climate risk data as a whole.
Thank you. Peter, have you got any thoughts on the whole calculation of climate risk from a risk system point of view?
Thank you. I think I suppose where we're coming from it is from the perspective of our clients who are asset managers, who aren't necessarily sort of all Article 8. A lot of them are Article 6. They've been told they have to integrate sustainability into their risk management process. They look at what is called risk in the climate space, and I think they struggle to see how it relates to what they think of risk in the market space. Timescales are just different. You know, if you're an investment manager, you're looking typically, now obviously not for all, at a timescale that's sort of, you know, a good investment, maybe a year, 3 years maximum is the sort of timescale. What is considered risk in the climate space is 15 years. Some of them go out to 2100. I think convincing an investment manager that something that's going to happen in 15 years based on data, which we all agree is a bit iffy, with an unknown probability, it's difficult to describe it as risk in the way that they would understand risk. And I think one of the things that I think is most important about discussions like these is to try and ensure that when we're talking about climate risk, I mean, you mentioned the EDEC, you know, the EDEC prediction, I suppose, that infrastructure is down by 50%. Well, yeah, that's
if nothing happens to
if
climate,
nothing happens, which is a fairly good bet. And by 2050, if that's the case, people would react to it. But clearly, you know, risk is something you can at least have a good idea around. You know, it's unlikely to happen, but most likely. But it has to be happening in an actionable time period. And I think one of the things which we need to be extremely focused on, if we want to talk about investment managers who are not those that are specifically focused on the sort of the 15 to 30 year time horizon, how do you have an actionable climate risk program that involves making decisions to avoid certain risks that are within, let's be honest, the time horizon of a fund manager? And I think it's very important to sort of consider not just the fact that, yeah, it's bad, but also, you know, what is the timescale for this? And is it consistent with an investment horizon?
That's a very interesting point. If I've understood it correctly, and I'd love to get Paul's comment, perhaps as well as yours too, on this. So if I've understood what you said correctly, you're saying that the fund managers, the asset managers, the guys running the funds are thinking these very short time periods of 3 years or so. But, you know, the sovereign wealth funds and even the pension funds, when they invest in infrastructures, we're using that as an example, it could be many other strategies as well, are thinking much longer term than that. So haven't we got a bit of a problem here? Paul, do you want to take that?
I will, yes. So yes, you're correct that sovereign wealth funds and pension funds can have a longer duration in that for pension funds, they're paying pensioners out over many years, following on years, and sovereign wealth funds are saving for future generations. However, you are investing in the real world, as distinct from what was quite well described as what could be seen as a theoretical world. Sure. So you have this bifurcation by everybody showing you historical data, and then when you're looking at future path data, there's a predictive element to it, which actually by default then means that once science begins to be somewhat predictive with parameters around what those predictions are, like, you know, the guardrails of those predictions, then people are going to test those. So if you think of it from an investor's perspective, you know, we talked about the EDHEC survey and them suggesting that it'll fall by 50%. Well, frankly, inflation and interest rates have had a 15% hit on the infrastructure market in the last 3 months. So, like, you know, so if I'm an investment manager today, that's what I'm focused on, because that's, you know, that my fiduciary responsibility is investment returns primarily, and particularly if you're in the US and you're under the regulatory environment of the SEC, you're very focused on that fiduciary responsibility of returns first, which has created this blue-red state divide around the term ESG. So I think there is definitely a duration mismatch between the way the industry invests and the need for us to be focused on a climatic outcome that is better than what we have had before. I think for sure, as Peter says, the data and the data providers, they conflict with each other. You have a menu of opportunity in terms of the outcomes around how a company is rated to decide on whether they are a Article 8 type of investment or an Article 9 or are they Article 6 if you take it in an EU context. And I think actually maybe a simplification is needed rather than us getting more scientific about it. It's a very pragmatic problem we're dealing with. And at the core of it is a decarbonization issue. And that's a planetary issue for us all, is to be focused on decarbonization and how we can do that. And it also using the right tools for this. If you think about it today, we're talking about how you make portfolios better. Broadly, what we're talking about is equity portfolios. It's listed equity portfolios. Fixed income, it's quite difficult to do this in. And by the way, if you really are, if we do go to the extreme of trying to rank fixed income on the basis of, countries that can deliver bonds that are green, we'll suddenly have a dearth of people investing in the emerging market economies because, they can't play that catch up the same way as the Western world can. So I think that there is this is a complex problem to solve. And I think we tend to look for more simplistic solutions because I think the solutions are driven out of political need as distinct from the imperative of, thinking about those sovereign wealth funds and the future generations, thinking about those pensioners. Pensioner in 10 years' time needs to get a pension and somebody needs to be investing on the basis of delivering that return. And that's the focus for the pensioner. And that's got to be the focus of the manager. Now, we have to find a medium by which they can actually do that and also be responsible for the planet. And I think that that's part of what we're trying to do at Haven Green in our focus. But I think people underestimate in the simplicity of the argument, the actual complexity of the solution that has to be delivered underneath it. Our view is focus on decarbonization. And if that is at the heart of what you're doing, you're broadly and directionally going to be heading towards a good outcome, would be the way I would think about it on portfolios. So I'll hold there, but there's probably a lot of questions.
We've got an awful lot to go through, and we've already, depressingly, you're at the bottom of the hour, so in theory, only half an hour to go. Questions just come in, which I really like. There's another question here, which I also like, but this second question is very relevant to what we're just talking about. So I'd love for you, anyone or all of you, to pick this up. And here's the question. If climate change continues to be difficult to quantify, will its risk always be underestimated? How about the man with the PhDs with that sort of quantification? Was your any of that?
Okay, well, it's okay if you want to put that hat on. It's a biased question because it says the risk will be underestimated. Well,
if it's difficult to quantify, will it be taken seriously?
Underestimated, overestimated? I think taken seriously is actually a much better idea because is a much better thing to take. Because Frank, you have to sort of look at this. And again, you talk about sovereign wealth funds have a 50-year time horizon. I can assure you, and many managers will assure you, they don't invest with a single manager for 50 years. So if you underperform for the next 3 years, I'm afraid you will get a call, irrespective of how green you are. And so I think it's more a question, and this is in no way a climate denying. I think Paul's actually got it right. It's not difficult, but you work out what you can quantify. We have a number of, I dislike the concept of ESG as baggage, Simon, but we do have quite a few clients who go, look, we'll concentrate on carbon, be it intensity, be it scope 1, scope 2 in the portfolio, because at least that I can measure. And if I have a declining scope 2, scope 3 emission in my portfolio over the next 3 years, that's the thing I can actually look at and decide to do. That's not difficult to quantify. And so if you actually want to get to things which you can do something about, yeah, you can do it. It's trying to actually say that a 30-year measure of risk is going to impact someone's behavior over the next year. Yeah, that's difficult to determine.
Right. Anyone else want to answer that particular question from the audience and or pick up anything being said, Karina or Paul? I got a lot of questions to get through, so don't feel you have to. But is there anything you want to say?
I'd endorse the answer from Peter. I think actually it's, what we have here is a shift. I think we have to bring it into terms that we can actually manage as an investment management community. And decarbonization is a fixed target. I think we can also debunk then those who are actually using it as a cloak, the cloak of invisibility. I would suggest is where they talk about my portfolio is less carbon impact than the index. That's assuming that the index in somehow is actually a good place to start from. I think actually I think demonstrating a progressive decarbonization approach to your portfolio is probably a far better way to measure you. It's in terms of your impact effect on it. And you have one question up there: do fund managers publish data on the benefits that they're sustainable?
Yeah.
Sorry, that's the purpose of Article 8 and particularly Article 9 is actually to focus on the reporting structures and speaking directly to the impact that you have on it. And again, I would say here, your challenge in this environment is that you're talking about something that it's in the hands of the author as to how they'll actually describe that. So I think that's why, and we will talk about it a little later on, is the regulatory environment and how that is. I think it's why it's important that there's a regulatory push in this. I think we have to work out where the balance is, because the regulatory push is a reaction to, yes, climatic change, but also is a reaction to, in certain instances, to political pressure, and particularly if you see it in the European Union. You have the Commission taking one stance, and then you'll have the Parliament taking another stance, and trying to find the balance between the two of those is very important. And it's a difficult balance to find because it's the regulators who have to find that balance in it. But I think, yes, reporting is happening. I will point out that there is quite a number of Article 9 funds now at this stage are stepping back from that status back to Article 8. And you're beginning to hear the Article 8 plus type of fund, or whatever that. I know that that's not an official term, but I've heard that comment made around. But again, it's a redrafting of the rules. And I think actually the one important thing is we have to realize that the questions are all going to be very valid, because the questions are ones that where you're looking forward to some outcome that we really don't understand just yet. And we don't understand how quickly it's pivoting towards us. Frankly, anyone saying to an investment manager, think about 2050, is that's not going to work. Exactly to your point, sovereign wealth funds are pensions managers. If you're underperforming 12 quarters in a row, you're getting fired. Unless there is a very plausible reason, or there's a real ethically driven investment ethos behind it, where they're willing to take losses relative to the returns they can get for the ultimate pensioners or wealth outcomes that they're responsible for. I think actually, perhaps in the family office space, there is an ability to have that a much more stronger ethical code around how you think about that investing. But in most instances, the fiduciary responsibility of returns kicks in, and people have to think about that. That doesn't mean you have to buy bad companies, just by the way. It just means you have to think about it a little bit more around intrinsic value. And maybe we can touch on fossil fuel companies later, actually, because I'm sure that'll rise.
I'm going to crack on, because I'm already getting to this sort of feeling. We've got a lot to cover and we haven't touched upon yet. So let's keep cracking on. I want to touch on very quickly. It's a bit technical, but we touched upon it in the prep call. Climate value at risk, or climate VaR. Peter, I think you said on prep call that there's lots of problems with it, but I think hopefully you will concur with what I said in my introduction, that it's the least bad alternative. Is it becoming the standard?
I would definitely concur it's the least bad alternative. It's equally inappropriate for everything, which I think is fantastic from a risk perspective. Yeah, there's nothing perfect for anybody. Well, it doesn't keep me in business, sadly, but So I do think, and also I think a lot of work has gone into it to ensure that it is actually applicable across a wide range of asset sectors, et cetera, et cetera. So it is good. I think, again, and I've touched on this before, the problem is its timescale. I think that it's a way of looking at climate risk, which I think a lot of people agree on, but I think managers struggle with the timescales associated with it. To give you an example, you know, for a UCITS fund, it thinks VAR is a 20-day forecast. Okay, so that's what a UCITS fund, you'd talk to a UCITS fund manager and talk about VAR, he'll think 20 days, or she will think 20 days. You tell them that I've got a risk metric that lasts for 15 years, and they're gonna sort of look at you slightly sideways. And I think one of the challenges you have to do is sort of look at these 15 years or longer or whatever, and try and come up with a way of saying, look, this is a forecast, but there has to be a way of getting from A to B. And that's what we need to start thinking about in terms of making this not only in the climate community, but also in the investment community. So you have something that actually is actionable on both the shorter and a longer term scale.
Right. Unless anybody would like to take that question, and you please do if you'd like to. What I'm going to do is switch in a second to the other areas we haven't touched upon, regulatory litigation risk and the other things which I do want to touch upon. However, I've been looking at the questions that are coming in. I think we've had some absolutely fantastic questions. What I'm going to do is, before we go off the sort of portfolio management and risk management stuff, I'll take the questions that we haven't answered, which is most of them. And so please take what you want out of these, and then we'll move into the other areas. So Paul did touch upon this. The first question that came in, which it's a very good question from somebody. Do fund managers publish data on the benefits that their sustainable funds have on the environment? Someone just said that's in SFDR, but this sort of presages the regulation bit we're moving on to. What are the benefits and costs of more climate regulation for fund managers? And someone's put in a question: given the high concentration of asset managers, with PwC projected top 10 will manage greater than 50% of global AUM, is there consensus among the top managers on how climate change should be addressed by investment managers? And then we've got, if there are risks, there has to subsequently be opportunities. Could you describe some of the growing opportunities in the impact space over the next 10 to 20 years? So if anyone want to take any of those, and then we're going to go off into another slightly different angle for the remaining 20 minutes or so.
I'll touch on the opportunities. I think actually one of the things that hasn't happened is the academic community hasn't caught up with this trend quite as much as they think they have. I think they've caught up with the trend of explaining why it's a crisis, but they haven't caught up with the trend as to why it's a great investment opportunity. And I would go back to the work of Fama and French in the 90s, where they identified these momentum factors like growth, value, small cap, mid cap, those type of effects. What we have to move on to is understand that we're now in a super factor mode around a few areas, and decarbonization is definitely one of those. So resource efficiency, focus on resource efficiency. I think diversity has become one, but that's obviously another paper for another day. But I think all of these are super factors that are happening, and whether it's the Inflation Reduction Act in the US or the EU's subsidization programs that they're involved in at the moment, it's creating a momentum behind these. And I would think that the next Nobel Prize winner for economics at some stage in the next few years is going to actually have a strong write-up on this whole area of super factors and how you incorporate those in investment portfolios. And I think if you're thinking about what is the opportunity? The opportunity is to stop thinking like we did in the past and think like we can for the future. So, and I think that that's where it would come. I also think there has to be some realism on impact investing. The reality of it is true, measurable impact investing is probably most likely going to come in the private market space. There's a handful of really great managers in the equity side who actually have delivered through equity investing, but it's by no means it's by no means wholesale. I will say, on the concentration point, to hit one other one, I think there is a consensus at the investment management side, and it does come down to decarbonization if you look at those largest managers. However, there's also a danger with 50% of them running the assets, is that the consensus view becomes an averaging as distinct from a strive for excellence. And I think we need to make sure that we're striving for excellence. in terms of the outcome here, because it really is the only way we actually can build that future out that we all wish for our grandchildren.
Okay, anyone else want to touch on those? Otherwise, I'm going to skip forward to a question on regulation and go to Karina on that. So, Karina, I'm going to go further ahead and to ask you about how much you think that managers should worry about regulatory risk with regard to climate investing. And when we were on having our prep call, you mentioned the rating agencies, the regulation of rating agencies. Perhaps you could talk a little bit about that, because it's not an area I personally know very much about, if at all.
Yeah, so I mean, as I mentioned earlier, you know, we've come from an ESG data market, which was initially very much like the Wild West, and probably still is a little bit like that, to a climate risk data market where you've got quite low barriers to entry, largely unregulated, and a very broad range of players. And yet these ratings, indices, scores are becoming hugely influential, and are you know, being used in important investment decisions. I think, you know, one of the challenges with ratings has been that they're very difficult to quantify. They have so many different dimensions compared to credit ratings, for example. So many different methodologies that are being developed to calculate these ratings, and significant variations between one rating and another, one risk score and another. The other challenge that we've had, of course, has been the quality of data. So data being brought from a very broad variety of sources, quite difficult to verify and validate that data, and sometimes a lack of transparency over the actual data sources that are being used. And so we're starting to see proposals for the regulation of this rating agency, of rating agencies. And I mean, looking at some of the initial proposals for the UK, it looks like not-for-profit rating agencies are going to escape regulation. And the data itself right now is going to escape regulation. And you've also then got differences across different jurisdictions. And so, you know, whilst it's an interesting step forward, it's an industry that has to be regulated. I think we're not quite there yet in terms of the regulation itself.
I mean, when I've looked into the biodiversity field in a little bit of detail, it is mind-bogglingly complex, the different ways people are doing it. And in a way, it's alarming, because there's quite a lot of good charitable stuff that goes on in that sector. Fund managers like Schroders are doing it one way, somebody else is doing it another way. There absolutely nothing equates with anything else, and there's no harmonization coming at all. So I don't know how we're going to progress into, I was going to say arcane, I don't mean remotely arcane, but I mean very specialist areas like nature and biodiversity. I know there's the TCND that's come along that's supposed to be helping and stuff like that, but it's a long way off anything happening here. And it does give people who, I don't think there are many, but it does give anyone who may be a charlatan an opportunity to do something a bit naughty in this space.
It does. And I mean, added to that, Simon, is the cost of all of these different data sets. And, you know, the requirement for data is not going to decrease. You know, as you said, we're adding new climate risks from a reporting perspective. So, you know, costs are definitely going to be a concern.
Right. Do either of you, Paul or Peter, want to talk about the rating agencies and the regulation in general? We will have a question specifically quickly in a second on SFDR, because we did talk about that in some length in our prep call, so we'll talk about that in a second. But before we get on to SFDR, have you got anything else to say about regulation and in some of the areas like nature, biodiversity, and other? Do either of you come across that in anything in that world at all?
Yeah, not on regulation, but on ratings agencies, given what we saw in the financial crisis, and that I think there's always a danger because everybody wants to get to single score answers. And it's kind of a one-dimensional answer to a three-dimensional problem. And I think that that's the biggest issue that you're going to have with something like that. It'll never be perfect. So I think actually there's got to be a lot of guardrails around that. But that's just the comment on rating agency. I get nervous when I hear. I mean, Peter alluded to it in our prep. You take all of the data and you try and amalgamate it together. I think that that's quite important to do because you got to get to the least risky outcome from an investment perspective. And if there's a variety of views, these rating agencies can conflict with each other today. It's not a fine art at this point.
Okay, let's get on to the SFDR. By coincidence, there is a question that's come in on that. The question I was going to put you, I'll put you first, which is whether or not the industry is bedding down with SFDR. Perhaps you could let us know what you think of it. And the question that's come in from one of the attendees is, will other countries adopt regulations similar to the SFDR? I haven't seen that in the US or anything else, but still, over to you. This is your field, probably, Peter, more than anybody else's.
Okay, will countries adopt similar to the SFDR? Well, if the US doesn't come anywhere near it, I think you're going to struggle. And from an investment perspective, if the US isn't adopting it, then yeah, I don't think so. But however, I think from an actual regulatory perspective, the SFDR is fascinating. First, I think the industry is bedding down. We've had sort of comments from both the Irish Central Bank and the CSSF sort of in the last year, sort of giving further guidance on how it's going. I think it's sort of, people are getting a better idea. It would still be nice if they tell us what exactly is Article 8. That would be helpful. But for the moment, I think it's actually gone in fine. I think, however, what people have got to look at is SFDR is basically a pull sort of mechanism. In other words, build it, Article 8, and the investors come. And it's about sort of, and we've seen certainly in Ireland, like 25% of the AUM is now in Article 8 funds. However, you've got to ask yourself, if you actually want to get somewhere faster, should it turn into a push mechanism? In other words, is SFDR2, should that be more about making Article 6 harder to achieve than Article 8? Because at the moment, there's a default. And if there isn't the continual flow of investments into this area, I think you'll struggle to get the numbers a lot higher, because you need to see, I mean, a lot of investment flow in the last couple of years, but I don't think it's been followed through. There's still a lot of Article 6 funds out there. So I think what I think the next level needs to consider, whether they do it or not, it's another matter, is making Article 6 just onerous. Because at the moment, it's not.
Right. Anyone else want to say anything about SFDR? I've got one or two more questions in the time we have available.
Very quick one on SFDR. I think to the blunt question, will other countries adopt regulations similar to SFDR? I think the answer is yes. I think they will. I think the US will follow, but I think they're in a particularly difficult situation at the moment prior to the upcoming elections. So I think that's their challenge in some ways to it. But I do think they will all roll in with a standard, and I think having one is better than not having one. And I agree with Peter on it. I think we'll know we're getting to a successful place when we stop getting excited about the amount of allocations that are going into Article 8 and Article 9, and we start talking about there still are allocations going into whatever the Article 6 and beyond or below are. So I think, yeah, it's a good starting point. I think there's a lot still to be done, and I think the regulators should treat it as a living organism, and that they should come back and revisit it and take the learnings out of it, because both the regulators are learning and the industry is learning how to adapt around Article 8 and Article 9. So live forums, I think, are going to be very important in going forward.
Okay, thank you. Can we sort of now spend a few minutes on the subject, which we haven't really touched upon yet, of the governance and whether or not the governance of the fund industry, where A, the fund boards, people on fund boards, but B, the people on the corporate boards of the asset managers are going the right way in order to take on board what's going on with the climate. There's been a lot when we were doing our preparation for the white paper, there's a lot of people from the FRC that I quoted to others who saying they're not, and that the answer to get this right is to get good governance structures in place. And if you don't get your good governance structures in place, then the chances are you may well be missing out on allocations from particularly professional stroke institutional investors in future, because they're going to do substantial amounts of due diligence to show that they're picking the right managers, have got all their sort of the right things in place in order to hold someone's money, because they don't want the litigation risk. So what do you think about what could be done in terms of governance structures? And also, I'll do a rider to that question, is do you think there are many people who are independent fund directors that know enough about this, or do they not need to know more than they currently know about this? A number of questions jumbled up in there. Peter's probably have more contact with the fund directors and others on this panel.
I think, okay, from a governance perspective, I understand where you're coming from, Paul. However, from a Manco, from a funds board perspective, what they need to ensure is that the proper policies are in place. And I think I'm cautious of saying that they need to have an ESG an environment or even a climate expert on the board. Absolutely. I think what they need to have is people on the board who understand what are the policies that are required to fulfill their mandate. And I wouldn't be quite so as enthusiastic. I think, the Article 6 funds are still out there, and they are still a vast majority of funds. And the amount of understanding of this you need to maintain that is not huge. I do think the idea that, you can have an Article 8 fund without having a proper set of governance in place is to be, that just doesn't make sense. But I think in large extent, and also because of the regulatory push, the governance around the sort of the environmental, social, and governance, to repeat myself, is actually fairly well formed. I think this is part of the success, as it were, of the SFDR. There was a requirement, and recent guidance has given you even more information on what is required to do this in line with regulation. I think it's important to get it in place, but I wouldn't actually, I wouldn't be of the opinion that there are sort of large numbers of Article 8 funds who haven't done their homework. I mean, there is an open question about what is an Article 8 fund, but I think around the fact that they need to sort of monitor various things, they need to have in place the ability to demonstrate their monitoring and stuff. I think that's fairly well established.
Do you have any comments on that, Paul, at all, or not?
No, I'm broadly agree. I think actually it seems to me bizarre if you have an Article 8 fund and you haven't got you haven't sewn up your governance on it. I think you're taking an enormous risk, both as I think you're taking corporate risk, and you're also taking risk on behalf of investors who want to invest in that fashion, because that's why that choice was made. So I think that's in essence a breach of fiduciary duty, I would say, on that. Yeah, but on the litigation side of it, we do, it's probably not as prevalent as it is in some other jurisdictions in Europe. I mean, you're seeing some of it. Some of it, I've got to say, it does feel like a little bit of, especially this fossil fuel debate. I don't understand how people would think that the answer is to stop using fossil fuels. Like when, even our own governments are admitting that has got to be a phased process. But the fact that we have a phased process, I think we should be interrogating fossil fuels companies differently around stranded assets and their net zero targets. That's a better way to judge fossil fuel companies than it is to say, we're going to take our money away from you and we're going to leave it to less conscientious investors to invest in you who won't care about these things. I mean, I just think it's like this, to me, that kind of litigation is just, it's a virtuous signaling. It would be the way I would look at that. I think it's much more important to be an agent for change than be a recipient of bad outcomes. And that's what we're going to end up doing if we continue on that path.
Green, a question that's just occurred to me in light of what both Peter and Paul just said with regard to when you're talking about flood risk to fund managers or asset managers. Do you find, and the stuff that we've recovered in the white paper about the fact that a lot of fund managers don't have the right governance structures in place, do you find, obviously I'm not going to ask you to name names, but do you find when you're talking to fund managers a wide variety of different responses so they understand the importance of flood data, or as in your case, or it could be extreme weather, temperature data? Do you find a wide variety of answers? Is this sort of an evolutionary thing, or do you find very similar answers from the major fund managers to what they say?
Yeah, interesting question, Simon. I mean, I think, the days of drawing ESG data or climate risk data from a single source or from a limited number of sources are over. What we're experiencing in the asset management industry is a move to a multi-model approach, whereby data and information is being brought in from a wide variety of sources and modeling done on that data to understand climate risk to assets and to portfolios. But it really varies across the industry. If you think about the very large global asset managers, the large investment banks, they have the benefit of niche skills in geospatial technologies, for example, niche systems and platforms that they can use, through to the broader industry, where I think there is still some confusion, if you like, in terms of reporting and data and requirements. And of course, increasing concern about the rising cost of staying compliant and the rising cost of accessing more and better data.
So it's mainly a function of size, is what you're saying?
The majority of the work that we do is with the very large managers and investment banks, yeah, and it does come down to be a function of size. Now, as that geospatial data that I've talked about starts to be integrated into ratings and scores and into niche ratings and scores, particularly for climate risk, then I think the broader market will be able to get access to those technologies, which up to this point have been the preserve of the very large managers.
Thank you. I was just looking at the questions. There's one or two we didn't get to answer, but I am going to read the last one out, which isn't a question, because it's a very good way to end on. It's from somebody, I have no idea who it is. Thank you, sir or madam, who's sending this in. And he or she has said, most realistic panel it has been my pleasure to listen to for a long while. So if you want to identify yourself later, we'll send you a check to wherever you want the check sent to for putting that on, sending that through. So well done, everybody. Thank you very much for a really good panel. I promised to end it by 4 o'clock UK time, which I'm a man of my word. Thank you very much, Peter, Paul, and Karina. Again, thank you, Fathom, for support you've given to this and the white paper. As I said at the very beginning, to all of you out there, we'll be delighted to send you the white paper, and we'll probably have something on that to tell you about tomorrow. So have a very good morning, afternoon, or whatever it is, wherever you are in the world, and hopefully see you the next time. Thank you all again.
Thanks very much.
Thank you. Bye-bye.
Thank you. Bye-bye.
Thank you.